All right, let's talk about one of the most reliable systems out there, the 20 and 50 EMA breakout strategy. Seriously, this is the kind of setup that pros love because it just cuts through all the market noise. It helps you filter out those frustrating fakeouts and really zero in on when a trend is the real deal.
You know the feeling, right? Price starts to move, and that one question just screams in your head, is this it? Is this the real move, or am I about to get totally trapped? Well, by the end of this, you're going to have a powerful framework to answer that question with a whole lot more confidence. So let's get into it.
First, let's meet the two main characters in our strategy. We're not going to clutter our charts with a dozen confusing indicators. Nope. We just need two powerful lines, the 20 and the 50 exponential moving averages. You'll hear them called EMAs.
Now, these two EMAs, they tell you different parts of the same story. That 20 EMA, the Scion one, it's like the market's pulse. It hugs the price really closely, and it shows you the immediate short-term momentum. It's where the fast money is. But the 50 EMA, that gold line, is slower, steadier. Think of that as the big underlying current. It shows you where the medium-term institutional money is positioned. They're the ones who need to see sustained strength before they jump in.
So here's what it all comes down to. When you see both of these EMAs sloping up and that faster 20 EMA is riding nicely above the slower 50, that right there is a healthy, confirmed uptrend. This alignment is the big green light we're always looking for. It's the market telling you loud and clear that buyers are in control. Okay, so we've got our tools. We know what a healthy trend looks like. Now for the fun part, how do we get in? There are two main patterns we're going to watch for with this strategy. There's the initial breakout, and then there's the one the pros really love, the retest.
In this pattern, this is what really separates the amateurs from the pros. See, instead of chasing that first huge green candle, that breakout, a seasoned trader waits. They actually wait for the price to pull back and touch or retest one of those EMAs. Why? Because the big institutions, they don't chase prices. They buy on the dips. This retest gives you a way better entry price and, maybe even more importantly, it confirms the trend is strong when it bounces and continues up.
Now, let me show you something special. Every once in a while, you'll see the price get squeezed super tight between the 20 and the 50 EMAs. We call this an EMA squeeze. You'll see volume dry up, the candles get tiny, it's like the market is coiling up like a spring. And when it finally breaks out of that squeeze, the move is often absolutely explosive. It doesn't happen all the time, but man, when it does, it can lead to some massive trades.
All right, so we've got our trend direction and we've got our entry pattern. But there is one more piece to this puzzle, and it is absolutely critical. I'm talking about volume. Volume is what tells you if a move has real conviction, if it has real money behind it, or if it's just a weak, indecisive little fake out.
And this just shows it perfectly. I mean, look at the difference. A breakout that happens on low, pathetic volume, that's a huge warning sign. It's got no fuel in the tank. But a breakout that's backed by a massive spike in volume, that's the confirmation you're looking for. That's the signal that the big players are stepping in, and this move has the power to keep going.
You should burn this quote into your memory. Price can lie, but volume tells the truth. Price action can fool you with fake moves and tricky candles, but a huge, genuine spike in volume, that's really hard to fake. It shows you what's really happening under the surface, so you have to check for it. Okay, let's put this all together now. We're going to build a simple but really powerful final checklist. This is going to help you instantly tell the difference between a high probability, clean setup and a low probability, dirty signal that's probably just a trap.
Think of this slide as your cheat sheet. On the left side, you've got the clean breakout. The EMAs are sloping up, you get that big volume spike, and the candle closes strong above the lines. Perfect. But on the right, you've got the dirty breakout. The EMAs are flat, volume is weak, and the candles have these long, ugly wicks that just scream indecision. You've got to learn to spot these dirty setups and just stay away from them. They're designed to take your money.
Knowing when not to trade is just as important as knowing when to jump in. So here are your big red flags. If the EMAs are flat and the price is just chopping around sideways, just stay out. If you see a breakout happen on low volume, stay out. And if there's a huge resistance level sitting right on top of your breakout, be patient. Wait for a cleaner signal. Protecting your capital by sitting on the sidelines is a winning trade.
Here's the final thought I want to leave you with. Every single chart tells a story. The price and the EMAs, they give you the plot, but it's the volume that gives you the emotion, the conviction. It's the difference between a whisper and a shout. So the question is, when you look at a chart, are you really listening for the volume?